Welcome to Logic and Liquidity, your source for smart financial analysis.
Welcome back to the Deep Dive. Today is Sunday, January 25th, 2026. And if you are listening to this, you are standing on the precipice of what might be, well, the single most chaotic, consequential, and frankly confusing week in financial markets that we have seen in years.
It is. It's definitely a week for the history books.
Hmm.
I mean, usually when we sit down to do one of these, we're looking at one specific theme, right?
Right, one big thing.
Maybe it's a big earnings release or, perhaps a central bank meeting.
Yeah.
But this is something entirely different. This is a collision.
Exactly. We are calling it Convergence Week. You know how sometimes you have a busy week where maybe one big tech company reports or the Federal Reserve meets?
Sure, that's a standard quarter.
Well, imagine taking the biggest earnings week of the year, stacking a pivotal Fed decision right on top of it, and then, just for fun, throwing in a bizarre but incredibly dangerous geopolitical standoff involving Greenland, of all places.
And tariffs. We absolutely cannot forget the tariffs. They are kind of the glue holding this whole chaotic picture together.
Right, the tariffs. We are staring down the barrel of a week where systemic risks are aligning in a way they rarely do. We've got the Magnificent Seven, or at least, the ones that still matter, reporting earnings.
Yeah, the core group.
We've got a Federal Reserve that seems to be fighting for its political survival. And we've got gold, of all things, shattering records.
And to make matters significantly more complicated, we are doing all of this while, well, effectively flying blind.
That is the part that really keeps me up at night, and I want to start there before we even get to the schedule for the week. We need to talk about the fog of war aspect immediately, because usually when we go into a week like this, we at least have the map. We know what the GDP is doing.
You have your bearings.
Exactly. We know what inflation looks like. But this time
is different. The U.S. Bureau of Economic Analysis, the BEA, dropped a bombshell administrative update that has, I think, flown under the radar for the general public, but has institutional investors just sweating.
I'll bet.
They have delayed the release of the fourth quarter GDP report. It was supposed to be out this week, Thursday, January 29th. It has now been pushed all the way back to February 20th.
February 20th. That is nearly a month late. I mean, in the world of high-frequency trading and algorithmic models, a month might as well be a decade.
It's an eternity.
So why? Why on earth is the most important economic data point for the world's largest economy delayed?
Well, it comes down to missing data. Specifically, the Bureau of Labor Statistics couldn't produce the full suite of consumer price index, the CPI data for October. You might remember those system outages they had last fall.
Oh, right. I do remember that.
So without that full inflation data, the deflators they use for GDP can't be calculated accurately. The models are just. They're incomplete. So here we are, walking into what could be the most dangerous week for money managers in years, and we don't actually know if the economy grew at 2% or 5% last quarter.
That is terrifying. It's like trying to land a 747 in a thunderstorm, but your altimeter is broken and air traffic control just went on a coffee break.
It's a perfect analogy. Because the market is a discounting mechanism.
Right.
It prices in the future based on current data.
Sure.
When you remove the most critical piece of data, the risk premium, the cost of safety, it goes through the roof. The market has to make billion-dollar decisions on Wednesday and Thursday based on assumptions that might be completely, totally wrong.
So let's unpack the stakes here. We are saying that Wednesday, January 28th, is arguably the most dangerous single day for money managers in years. It is the gauntlet.
Wednesday is the fulcrum. If you look at the schedule, it's just relentless. In the morning, you're trying to digest Microsoft's earnings from the night before, which is a huge event in itself.
A market mover on its own.
Absolutely. Then, at 2:00 p.m. Eastern, you get the Fed's interest rate decision. At 2:30 p.m., Chair Powell gets up to speak. And then the second the market closes at 4:00 p.m., boom, Tesla and Meta both report their earnings.
It is a gauntlet. And our mission today is to guide you through it. We're going to break this down into 3 specific sections. First, we're going to talk about the Fed, but not just the rates. We need to talk about the political war happening behind the scenes.
Which is critical.
Then we're going to debate the tech sector. Are these massive AI capital expenditures actually turning into revenue, or are they just a money pit? And finally, we're going to connect the dots to that Greenland story, which I promise you is not just a tabloid headline, it is a massive signal for the global economy.
And we'll wrap it up with a specific trade idea for the wind, something we're calling the Greenland hedge.
I love it. Okay, let's dive in. Section 1, the Wednesday gauntlet. the Federal Reserve.
Right. So the Federal Open Market Committee, the FOMC, they meet on January 27th and 28th. Now, if you look at the CME FedWatch tool or just talk to any bond trader on the street, the consensus is, well, it's overwhelming.
So what's the market actually pricing in? Is it a sure thing?
Well, sure thing is a strong word in this environment, but yeah, you're looking at a 95% to 98% probability of a hold.
So no rate cut. Rates stay where they are, in that 3.50% to 3.75% range. But if it's a done deal, why is everyone so nervous? I mean, usually a hold is a non-event. It's boring.
If this were a normal year, you'd be absolutely right. It would be the end of the story. You look at the data we do have. Inflation is hovering around 2.7% to 2.9% on the TCE index.
Which is sticky, but not a disaster.
It's sticky but not exploding. Unemployment is at 4.4%, which is a bit soft, but it's not a crisis. So a hold makes perfect sense economically. Just the Goldilocks scenario.
Yeah.
Not too hot, not too cold.
But this isn't a normal year. And the sources we have in front of us paint a picture of a Fed that is, for lack of a better term, under siege.
Under siege is exactly the right way to put it. We are seeing a level of friction between the executive branch and the central bank that we just haven't seen in decades, maybe ever.
And it's not just rhetoric.
No, not at all. The source material we have indicates that the administration is actively attempting to dismiss Governor Lisa Cook.
Which is unprecedented in itself. That just doesn't happen.
It doesn't. But even more alarming for the markets, there are reports of a DOJ investigation being opened into Chair Powell himself.
Wait, I want to pause on that. A Department of Justice investigation into the sitting Federal Reserve Chair. I mean, usually the Fed is this sacred independent cow. Presidents might grumble about rates. We saw Trump do it. We saw Biden do it. But they don't open criminal investigations into the chair.
It completely breaks the norms. The entire global financial system, the whole thing, is built on the premise that the U.S. dollar is managed by technocrats, not politicians.
Right.
That the person setting the price of money is looking at spreadsheets and economic models, not polling data. If investors, and I mean global investors, believe that monetary policy is being dictated by the DOJ or the Oval Office to juice the economy before the midterms, you introduce something really dangerous.
A political risk premium.
That's exactly it. A political risk premium gets attached to the U.S. dollar and to all U.S. assets.
Okay, explain that concept for the listener. What is a political risk premium in, practical terms? What does that mean for my 401k?
Sure. Think about it this way. Usually, when you buy a U.S. Treasury bond, let's say a 10-year note, you are taking on interest rate risk and inflation risk. You're making a bet on where the economy will go.
Okay.
You are not supposed to be taking on rule of law risk. You aren't supposed to have to worry that the person setting the rates might be fired or, arrested because the president wants lower rates for an election. When that risk appears, investors demand a higher return to hold that asset.
They want to be paid for the extra risk.
They say, if I have to worry about the Fed chair going to jail, you need to pay me more interest. And that higher interest rate ripples through everything. Mortgages, car loans, corporate debt, stock valuations, everything.
So on Wednesday at 2:30 p.m., when Jerome Powell steps up to that podium,
the market isn't just listening for hints about, are you going to cut in March? That's secondary now. They are watching his body language. They are listening for a defense, a really robust defense of the Fed's autonomy.
So if he sounds shaken, or if he sounds like he's bowing to pressure,
the bond market could riot.
Yeah.
It really could, because that would signal that the institution has been compromised.
And we're already seeing signs of that riot, aren't we? I mean, the term bear steepening keeps popping up in our notes.
Yes. And this is a technical term, but it's so crucial for everyone to understand right now because it dictates your mortgage rates, your car loans, and, the value of your stocks.
Okay, hold on. Let's break that down for a minute. What exactly is a bear steepening for someone who doesn't live and breathe treasuries?
Sure. So, in simple terms, a steepening yield curve just means the gap between long-term and short-term interest rates is getting wider. In a bear steepening, that happens because long-term rates are rising faster than short-term rates.
So the 10-year Treasury yield is going up, even if the Fed holds its rates steady.
Exactly. The 10-year yield is pushing up toward 4.23%, maybe 4.27%. And here is why it's so important. The Fed controls the short-term rate. They can pin that overnight rate at 3.5%, but they don't control the 10-year rate.
The market controls that.
The market controls that. And right now, the market is selling 10-year bonds, which drives their yields up. because they're worried about long-term inflation and fiscal chaos from Washington.
The bond vigilantes are back.
They are. They are effectively voting with their money against U.S. fiscal health. So if Powell comes out on Wednesday and hints that maybe this 3.5% rate isn't just a pause on the way back down to 2%, if he suggests this might be the new floor, the neutral rate, or per star as they call it, because of all this government spending and geopolitical turmoil,
Then what happens?
then risk assets could get crushed.
And when you say risk assets, you mean the stock market. Specifically, you mean the tech stocks that have been carrying the entire market on their backs for the last 18 months.
Precisely. If that long-term risk-free rate goes up, the value of those future tech profits goes way down.
It's just math.
It's just math. It raises the discount rate. Future cash flows become less valuable today. Which brings us perfectly to the second massive stressor of the week.
Section 2, the great tech debate. So we move from the cost of money, the Fed, to the companies that are spending the most money.
The Magnificent Seven, or as you said, what's left of them.
Right. Microsoft, Tesla, Meta, Apple, they all report this week. And the theme in all the research, I mean, it's clearly shifting. For the last 2 years, the trade has been pretty simple.
Incredibly simple.
Buy the AI promise. Buy us, because we're building the future. Now. The market is saying, show me the money, show me the revenue.
It's the transition from hype to execution. It has to happen eventually. Investors are looking at these massive capital expenditure CapEx numbers, and they're finally starting to ask, where's the return on this investment?
Let's start with the big one, the biggest. Microsoft. They report Tuesday night, January 27th, and they really are the bellwether. If Microsoft misses, the week is basically over before it begins.
They are the standard bearer for the entire AI thesis. And the debate here is just fierce. I mean, on the bull side, the optimistic side, you have Azure, that's their cloud computing division.
And the numbers there are still huge.
The projections are for 37% growth.
Which is massive for a company that size. That's essentially like adding the revenue of a small Fortune 500 company every single quarter.
It is huge.
Mm-hmm.
And the bulls will tell you this proves that the demand for AI compute, the actual infrastructure of the future, is real and it's massive. Companies are renting Microsoft servers to run their AI models. That is real money flowing in. It suggests the AI revolution isn't just, vaporware.
I'm going to play the skeptic here.
Yeah.
Because I'm looking at the bear case in our notes, and it's ugly. Microsoft took a $3.1 billion hit to net income directly from its investment in OpenAI.
That's correct.
And OpenAI, last I checked, is still wildly unprofitable. It is burning cash like a bonfire.
That is the friction point. That's the center of the whole debate.
So Microsoft is pouring billions into new data centers, billions into GPUs from NVIDIA, billions into OpenAI, and their own margins are under pressure. The fear is that this is a spend now, profit later trap. What if later never comes? Or what if it comes 5 years from now and the market doesn't have the patience for that?
That is the fear that is creeping into the market. If Microsoft reports on Tuesday that their CapEx guidance for 2026 is going up again, let's say they guide to $50 billion or $60 billion in spending.
Which is a real possibility.
A very real possibility. And at the same time, Azure growth ticks down even 1%, from 37 to 36. The market will punish them and punish them severely. The narrative will shift instantly from building the future to money pit.
And because Microsoft is such a huge part of the S&P 500 and the NASDAQ.
If they sneeze, the whole market catches a cold. It's that simple.
And that happens Tuesday night. So we wake up Wednesday morning, potentially in a very bad mood, and then we have to deal with Tesla.
Oh, Tesla. Reporting Wednesday, January 28th. This has to be the most polarizing stock in the world right now.
It really is. I mean, let's just look at the numbers. They delivered 497,000 vehicles in Q3 of 2025. That's a record. Sounds great, right?
On the surface, yes, a record is a record. But you have to dig just one layer deeper. Their margins are compressing. They are making less profit on every single car they sell. It's down to about 17% or 18% gross margin now.
And that used to be over 20%, right? I remember it was closer to 25% at their peak.
Exactly. They are slashing prices to move metal. And there's this October hangover that the market is really worried about. Remember, the big $7,500 EV tax credit in the U.S. expired on September 30th, 2025.
And then what happened in October?
New orders created by 40%, or 40% drop. That is a demand cliff. And it suggests that a huge number of people were only buying the cars because the government was subsidizing them.
It shows the price sensitivity.
It shows that demand elasticity is very real.
So here's my issue with Tesla, and I just can't get past it. It is trading at a price-to-earnings ratio, a PE of nearly 300. 300, that is insane for a car company. Ford trades at a PE of like 6. GM is similar.
It's a different universe.
It's a different planet. Tesla is facing massive competition from BYD in China, who has now outsold them for 4 quarters straight. So why is anyone paying 300 times earnings for a car company with shrinking margins and a potential demand problem?
Because, as the bulls will tell you, and they will tell you this very loudly, you aren't buying a car company. You are buying an AI and robotics company that happens to make cars for now.
But is that real? Or is that just a story, a narrative to justify the start price? Because look, if I'm buying a car company, I'm paying maybe $15 a share. If I'm buying a world-changing robotics company, maybe $300 makes sense. Which one is it?
That is the entire debate. That is what the earnings call will be about. The stock is holding up almost entirely based on 2 future promises. The timeline for the Model 2, the affordable $25,000 EV, and, more importantly, the progress of unsupervised full self-driving.
We've been hearing about FSD being next year for, what, almost 10 years now?
We have. Next year, next year, next year. But the testing data coming out of Texas is starting to look different. The intervention rates, how often a human has to grab the wheel, are dropping precipitously.
So it's getting better.
It's getting demonstrably better.
Yeah.
If they can convince investors on Wednesday that the cybercab, the robotaxi, is actually a real thing that is happening in 2026, the stock flies. If they delay it again, if they say, well, the regulatory environment's complicated, then that PE of 300 starts to look less like a valuation and more like a trap door.
So Wednesday night, Elon Musk has to pull a rabbit out of the hat. Okay, so Tesla is a wild card. Then we have Meta Facebook, also reporting Wednesday after the bell.
Meta is fascinating because they have successfully pivoted before. They pivoted brilliantly from desktop to mobile. Then they tried to pivot to the metaverse,
Which was an absolute disaster. What was it, $70 billion in losses? I still can't believe they spent that much on avatars that didn't even have legs.
a very expensive and painful lesson. But now, the source material says they've pivoted again, away from the metaverse and toward AI wearables, specifically the new Ray-Ban glasses.
I have to say, I actually see those everywhere now. You see people walking around talking to their glasses. It's becoming a thing.
They are a legitimate hit.
Yeah.
But here's the danger for Meta, and it's the same theme we saw with Microsoft: CapEx. Capital expenditures are expected to hit $72 billion in 2025.
$72 billion. That is the GDP of a small country. That's more than the defense budget of the United Kingdom.
It is a truly staggering amount of money. And this is what we're calling the CapEx shock risk. If Mark Zuckerberg comes out on that call and says, we're spending $75 billion next year on our AI infrastructure, and at the same time ad revenue, which is their actual business, their cash machine, softens even a little bit.
Investors are going to panic.
They will have flashbacks to the metaverse spending spree. They will sell first and ask questions later. They will not get burned again.
It feels like the unifying theme for all these tech companies reporting this week is trust us. Trust us that spending $50 billion on chips is going to pay off. Trust us that the robo-taxi is coming.
And that trust is expensive, and it's being tested. Which brings us to the last big one, Apple, reporting on Thursday. The ultimate consumer health check.
Apple usually feels like the safe harbor in a storm. But looking at these notes, the phrase Siri AI delay is jumping out at me. That does not look good.
Apple's in a very strange spot. They have 20% of the global smartphone market, which is an incredible, durable business. But their growth is trailing the S&P 500. For a growth stock, that's a problem.
So what was the story supposed to be?
The narrative was supposed to be the iPhone 17 supercycle. The idea was that everyone would finally upgrade their phone to get the new, amazing AI features built into the operating system.
But if the AI features aren't there...
Then why upgrade? Why spend $1,200 on a new phone that does basically the same thing as the iPhone 15? Apple is, by all accounts, lagging Microsoft and Google in the generative AI narrative.
So what do they need to do on Thursday?
If this earnings report doesn't clarify the AI timeline, if Tim Cook doesn't get on that call and show us specifically how Siri is going to become a world-class AI agent, then investors might start asking if Apple's becoming the next IBM.
Ouch. The next IBM. That is harsh. I mean, IBM's still around, they make money, but nobody gets excited about them.
Exactly. A great cash cow, but no longer the leader. It's the risk of stagnation. And for a stock with Apple's valuation, stagnation is death.
Okay, so we have a Fed under political attack. We have tech companies spending billions with very uncertain returns. That is already a tremendously stressful week. But now we have to talk about the thing that makes this a true convergence week. The thing that connects the digital economy to the physical world in a, well, a violent way.
Section 3. the Greenland signal and the missing GDP.
I have to admit, when I first saw Greenland in the show notes, I thought it was a joke, or maybe a distraction from the real news. Why on earth are we talking about an ice sheet in the North Atlantic during the biggest tech earnings week of the year?
Because it is not just an ice sheet. And this is where we have to connect the dots between finance and geopolitics. The news is that President Trump has renewed the push to buy Greenland. He's framing it as an absolute necessity for national security against Russia and China.
Right, I saw that. And Denmark obviously said no again. It's not for sale. They aren't a real estate agent. They are a sovereign nation.
Right. But then came the stick. This is what the market is reacting to. A 10% tariff on Denmark and 7 other European nations starting February 1st. That tariff then rises to 25% on June 1st if they don't agree to sell.
These are our NATO allies. Denmark, Norway, the UK, Germany. We are threatening a full-blown trade war with our closest military allies over an island.
It sounds completely absurd until you look at what is in the ground in Greenland. The U.S. Geological Survey estimates are between $2 trillion and $4 trillion in rare earth minerals and critical resources.
Rare earths. The stuff we need for all the technology we were just talking about. For chips, for batteries, for missiles.
Exactly. Neodymium, dysprosium, terbium. All the stuff that China currently has a stranglehold on. The reported U.S. offer is in the range of $500 billion to $800 billion. So, economically, there's a massive valuation gap. But geopolitically, this is what the market calls the weaponization of trade. It creates a rupture in the transatlantic alliance in NATO, right when security is paramount.
And this rupture, this instability, is frightening the market.
It is terrifying the markets, and you can see it in one place very clearly. Look at gold.
Gold is at $4,888 an ounce. That is a new all-time record.
It shattered the old record. Goldman Sachs just raised their price target to $5,400 an ounce. But you have to ask yourself, why is gold rising right now?
Well, the usual answer people give is inflation.
But inflation is stabilizing. It's running at 2.7%. You don't buy gold at nearly $5,000 just to hedge 2.7% inflation. The real rate of return on cash is positive. Gold yields nothing, so why would you buy it?
Then why? What's the real reason?
It is a trust hedge. Or you could call it a credibility hedge. Look at who is buying. It's not just individuals. It's central banks. Poland, Brazil, China. They're buying 60 tons a month.
And they aren't buying it because they like jewelry.
They are buying it because they are diversifying away from the U.S. dollar.
Because of the political risk we talked about earlier with the Fed?
Exactly. It all connects. If the U.S. can weaponize trade and tariffs against Denmark, a NATO ally, what might they do to Brazil? Or to India? Or to China? If the Fed is being investigated by the DOJ, is the dollar truly a safe, neutral asset? Gold is pricing in instability and a global lack of policy credibility coming out of Washington.
This is the aha moment for me. Gold isn't rising because money is worth less. It's rising because trust is worth more.
Precisely. Gold is the asset that is no one else's liability. It is the only financial asset you can own that doesn't rely on a government somewhere keeping its promise.
And this brings us right back around to where we started, to that missing GDP report, the soft landing mirage.
This is the final dot to connect. The stock market, the S&P 500, is priced for perfection. It is pricing in a soft landing. Perfect growth, low inflation, everything is great. The GDP Now model from the Atlanta Fed, which is based on the data we have, predicts 5.4% growth. That is incredibly hot.
But then you have a forecast from EY Ernst & Young predicting 3.2%. That is a huge gap between two credible forecasts.
A massive gap. And then you look at the reality on the ground, the physical economy. Tariffs have jumped from an average of 2.5% to 16.5% because of these trade disputes. Net migration, according to the latest data, has collapsed to nearly zero, which hurts labor supply and growth.
So the soft landing optimism in the stock market might be based on old, incomplete data?
It might be a mirage. A signal from the Greenland gold story suggests the physical economy, commodities, defense, energy, is bracing for a major storm. Meanwhile, the digital economy, the tech stocks, is partying like everything is fine and growth is infinite.
That is the convergence, the collision between the physical reality of tariffs and geopolitics and the digital fantasy of AI-fueled soft landings.
And when those two realities collide, usually the physical reality wins. You can actually see this rotation happening already under the surface of the market. Look at energy stocks. Exxon and Chevron are hitting new highs. Investors are quietly rotating out of paper promises like tech PE ratios of 300 into real stuff: oil, gold, land, defense.
So what does this all mean for us, for the listener trying to navigate this absolutely insane week?
It means you need to be extremely careful. Wednesday is going to be incredibly volatile. If Powell slips up in that press conference or if Tesla misses on its guidance, we could see a massive correction in a very short amount of time.
Let's synthesize this whole thing. We have a Federal Reserve under siege. We have tech companies spending billions with uncertain returns. We have a trade war brewing over Greenland. And we have the gold market telling us that trust in the system is evaporating.
It is a perfect recipe for volatility.
So we always like to leave our listeners with a trade of the week, an idea. Based on everything we've discussed, where do you hide? Or where could you potentially profit from this chaos?
Given the extreme volatility that I expect between the Fed announcement on Wednesday afternoon and Apple's earnings on Thursday afternoon, I'm looking at what I'm calling the Greenland hedge.
The Greenland hedge. Okay, I like it. Break it down for me.
It's a simple idea. The idea is to stay exposed to two things: gold and defense stocks.
Okay, gold makes sense based on what we just discussed. Why defense stocks specifically?
Because regardless of whether the U.S. buys Greenland or not, the broader trend is clear. The world is getting more dangerous and more fragmented. Tariffs on allies mean they can't rely on the U.S. security umbrella as much as they used to.
So they have to rearm.
Fragmentation means rearmament. European defense spending is going way up.
Yeah.
U.S. defense spending is going up. If NATO fractures, every country needs to buy its own tanks, its own jets, its own missile defense systems. It's a growth industry, unfortunately.
And gold is the other side of that coin.
Gold is your insurance policy. Even if tech earnings come in great this week, the geopolitical risk premium, those Greenland tariffs, the Fed uncertainty, that isn't going away. Gold is, I think, the safer play for the rest of 2026. That Goldman Sachs target of $5,400, that's the North Star here. It tells you where the smart money thinks we're heading.
So own the things that hurt when you drop them on your foot. Gold bars and tanks.
In a world where digital promises are getting shaky and trust is low, physical security and hard assets carry a premium.
That is a very sobering thought.
It is, but it's the reality of the data we're seeing across all these different sources. They're all pointing in the same direction.
I want to leave everyone with one final provocative thought, something to chew on while you watch the tickers on Wednesday.
Go for it.
We talk so much about AI replacing human jobs. We talk constantly about the digital future, the metaverse, a world of bits and bytes. But look at the markets this week. The biggest mover, the thing causing the most fear and instability, isn't an algorithm. It's a 19th century style territorial dispute over an island and a shiny metal we dig out of the ground. Maybe the future isn't just digital. Maybe it's brutally physical. If the data is missing, like the GDP report, and the dollar is being politicized, what do you actually own?
That is the question of the decade, isn't it? If your wealth is just digits on a screen and the system managing those digits loses credibility, do you really own anything at all?
On that cheery note, thank you for listening to this deep dive. Good luck navigating the gauntlet this week. Keep your eyes on the Fed, watch those earnings reports like a hawk, and maybe, just maybe, buy a little gold.
Stay safe out there. It's going to be a wild ride.
We'll see you on the other side. This has been The Deep Dive.